Ultimately, you need to take advantage of those first mover advantages, look for an exit strategy, look to be vertically integrated as a buyout opportunity if you can't go at an IPO or reverse takeover. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we're going to talk about cannabis retail opportunities, including franchising. This BDS Analytics report says that cannabis is perhaps the most exciting retail opportunity to hit the U.S. markets in decades. The lucrative combination of rapid sales growth, an ever-expanding customer base, and government-enforced protection against mass retail has resulted in a unique market that's unlikely to be replicated anytime soon. While dispensaries remain temporarily safe against the threats of competition realized by traditional retailers, the industry is not without its challenges. In addition to the expected woes of any startup retailer, cannabis dispensaries face the added financial burden associated with strict regulatory compliance, higher costs of capital, banking services, tighter profit margins, which is a result of IRS Code 280E, as well as limitations on conducting businesses across state lines. Nonetheless, the capital needed to grow retail businesses and build value was unleashed in 2018 when U.S. multi-state operators discovered the route to public equity via the Canadian Securities Exchange. And despite this year's brutal correction in those public values, the pool of public funding will only increase as the U.S. legal cannabis market evolves. As we've reported in the past, there's some strategies with some of these retailers having an adjacent store with just ancillary products that's kind of to circumnavigate that block on 280E so that they can write off pipes and rolling papers and CBD products. But there's a strategy behind that as well. There's a lot of push from retailers for the access to consume. So a lot of states have even implemented retail shops as the sole provider to consumption lounges or cannabis cafes. And I've had that headway in Washington state trying to draft that bill to allow for consumption in Washington. A lot of retailers want that exclusivity. And so we've seen in Washington a number of stores popping up with ancillary adjacent head shop. And in my opinion, that's just a real estate investment play or a REIT in order to grab some retail and use that for a cannabis cafe eventually down the road. The future of cannabis retailing includes some niche industries, including specialty coffee, craft brewing, and fine wine, to provide a glimpse into what the future may hold for cannabis markets. Each of the aforementioned industries started with enthusiastic single store operators who were able to keep a profitable niche for themselves, even as the bulk of total sales of the product category went to mass producers and mass merchants. So, cannabis retailers have an opportunity to do the same thing in a product category that will be amongst the fastest growing in the world economy for many years to come. Really, it boils down to offering an experience. So whether that's CBD coffee or otherwise, it's not about unique or niche. It's about what experience can you offer. That's what's going to be able to distinguish everyone. A lot of these brands are going to collapse because they don't have those margins. I've mentioned that Puerto Rico offers the opportunity for a 4% corporate tax cap. And so if you are involved in CBD coffee or anything else that's legal for interstate exchange, you have to look at Puerto Rico or you won't be in business. The specialty coffee that we saw, in Seattle, everything collapsed when Starbucks got their publicly traded money, expanded the stores at a loss in order to kick out mom and pops. What we have here now is bikini baristas, some kind of niche, weird thing. In my opinion, we'll see the same thing in cannabis as big conglomerates push out mom and pops for them to only pop up somewhere else in some weird niche category. So there are some first mover advantages, including the ability to license your operations. And since cannabis, you can't technically franchise because it's not legal, there are some ways of essentially doing the same thing as franchising your business to new emerging markets. You could look at Illinois or Florida or Germany. So, Marijuana Venture Magazine highlights harnessing the economic forces of franchising by saying that franchising in the U.S. is part of the nation's business culture and an economic force generating $451 billion throughout the country last year. So, it's not surprising that entrepreneurs in the world of cannabis are attracted to the fast-growing franchise can provide. In a franchise business, the franchisor provides a developed way of doing business, ongoing guidance, proven systems of assistance in exchange for the periodic payment of fees. But be aware there are federal complications that have not yet been tested. So, starting a cannabis retail store can cost in the hundreds of thousands of dollars. Operating a cannabis dispensary presents some unique challenges within this proven business expansion strategy. At the federal level, cannabis remains illegal in many states and still is a Schedule I drug at the federal level. So laws and regulations surrounding franchises exist in many states and at the federal level. So even if a state has legal cannabis, the federal franchise laws may still present challenges and state franchise laws may not have fully caught up with the state cannabis laws. Retail stores are in the best position to take advantage of this option. For a potential retail franchisee, there's three key advantages: retail cannabis experience and brand power without making the same mistakes as your competition. Cannabis retail franchisees typically get exclusive access to award-winning genetics and products, and better management efficiencies will likely position the franchise for consolidation as the movement towards a national industry progresses. So, in addition to MedMen, here locally, we've seen Have a Heart. They had a $25 million friends and family round. And then when they went to their seed round, or maybe it was a Series A, they went for 75 million and oversubscribed by 75 million. So total, they had 175 million to go play with. They went out to about 12 different states and got 20 licenses and ran out of cash. Really, as commercial real estate has never been any higher. So if there is any dip, you're going to see MedMen's stock struggle to support those values at the prices that they paid for each retail shop. We've also seen some cutbacks in employment, from Kush.com laying off half their force, Weed Maps laying off half their advertising force, Hexco laying off 24% of their force, Pax Labs laying off a fifth of their workforce. So it wouldn't surprise me if some of these multi-state operators started to consolidate. According to the data from the U.S. Bureau of Labor Statistics, about 20% of small businesses fail within their first year, and by the end of their fifth year, roughly 50% of small businesses fail. After 10 years, their survival rate drops to approximately 35%. So the learning curve and hidden expenses required for a cannabis retail startup are significant. Franchising generally consolidates the costs into a known flat fee or percentage of profits over time. And by removing a significant portion of risk, the franchisees are more likely to survive that critical first year, be well situated to thrive while the cannabis market in each region stabilizes. Having worked in the banking industry, I saw franchises for certain, Mexican shops go for about 250,000, or some of the sandwich shops, same thing, 250,000. So you get all of the billboards and the signs and the seating, everything. Basically, it's turnkey. So you have to pay $250,000, and then you get a turnkey franchise with standard operating procedures, training, all of that. And so we'll probably see something very similar in the cannabis industry rolling out. A lot of those benefits with franchising just comes from being able to have business as usual. A lot of franchise owners might be investors, but not necessarily, restaurateurs. And so having somebody give you a book on how to train people for management training and support, figuring out how to do the accounting processes or personal management, the facility development, regulatory compliance, standard operating procedures. All of the operating standards are usually established by the franchisor, which is also generally controlled quality and requirements, uniformity among the franchisees. So that experience helps reduce the mistakes that may be financially costly and time consuming. Ultimately, you need to take advantage of those first mover advantages. Look for an exit strategy. Look to be vertically integrated as a buyout opportunity if you can't go at an IPO or reverse takeover. Increase your SKUs to at least 15. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.